Is it possible to use the passive income from yield farming to cover your daily expenses? Can you live off of your yield farming liquidity pools? It depends. And in this video, we're going to cover what it depends on, a situation where you can live off of your yield farming rewards, situation where you can't, so that you know how to get to it, and all the things that come to my mind when people ask me that question. All right. So in this video, we're going to cover all that. I'm going to explain what yield farming is. So before I jump into it, I have to say none of this is financial advice. These are my own perspectives and opinions. Do your own research. Use this channel as a starting point. So without further ado, let's jump straight into it, starting off with what is yield farming. So it's multiple ways to get a yield in DeFi. You have money market funds like Aave, Compound, where you can supply assets and get a yield where people borrow, almost acting as a bank. You have staking, where you can stake on a blockchain's staking contract, such as the ETH 2.0 staking contract, and get like a 13% APY to secure the network. You can get a yield from insurance premium, so staking your liquidity on platforms such as Nexus Mutual. And then the way that we always talk about on this channel, the most profitable way to yield farm is using your funds as liquidity to facilitate trades on decentralized exchanges such as Uniswap, such as Aerodrome, such as Trader Joe, etc., etc. So you deposit your liquidity on these decentralized exchanges in the form of pairs. And whenever someone swaps back and forth between your pair, let's say it's ETH USDC, whenever someone goes from USDC to ETH or ETH to USDC in your pool, you make passive income. The amount you make is dependent upon the volume to TVO ratio and how much liquidity you have in the pool, how much of your liquidity is in it. So whatever percentage of your liquidity makes up that pool is the percentage of trading fees that you get, right? So can you use yield farming to cover your expenses? You always hear about people living off the interest from their dividend paying stocks, but those people have a lot of stocks. So as you can already imagine, you have to have enough to make it worth it, so that even if you're experiencing impermanent loss, you don't feel bad withdrawing your liquidity, right? An impermanent loss is just when you're providing liquidity, specifically concentrated liquidity, which makes your liquidity more efficient. It allows you to determine the price range where you can provide liquidity. So it's like if it's in an ETH USDC pool versus just depositing ETH and USDC and just saying whatever, like Uniswap V2, concentrated liquidity, aka Uniswap V3, allows you to say, hey, only use my liquidity when the price of Ethereum is between X and Y, right? When it goes out of range to the upside, you can think of it as a limit order for the underperforming asset. So if you have a range from 2,000 to 3K and ETH hits 3,100, you're in 100% USDC because USDC is the underperformer, and vice versa on the downside. If it goes out of range to the downside, you're in 100% ETH, right? So it depends on how much money you have. It depends on what your expenses are. It depends on your risk tolerance, right? And how much time do you have to manage your pools? If you want to get really risky, it's easier, but you want to have more time, or at least know how to use Aperture, which allows you to program triggers that says if I go out of range here or for this amount of time, rebalance me here, etc., which we teach you how to use in our course. You know, if you're interested in becoming a professional yield farmer or market maker and you want to learn how to deploy the same strategies that market makers such as Citadel, such as Goldman Sachs, etc., have been deploying for the past couple of centuries and making profits regardless of the market conditions, click the link in the description, book a free strategy session. You'll talk to me or one of our coaches, and we'll see if our platform is a good fit for you. I digress. The more time you have to manage your pools and the more money, the better. And it also depends on your expenses. If your expenses are really, really low, you don't need as much, obviously. So I can't just answer this question black and white. But what I can say, if you don't have lots of money, it's not a good idea, because impermanent loss will bite you in the ass. So like, let's say you're providing liquidity for ETH USDC from 2,500 to 3,500, right? And the market's been doing good. It's been at around 3,400 most of the month. And now the end of the month is coming. You want to take out your rent. And let's say it goes out of range to the downside. ETH goes to 1,700. You're not going to want to pull that out. Let's say you pull it out and then the market bounces back a week later. You're going to be salty, right? So if you had more than enough, it wouldn't hurt as bad. You know what I mean? You're going to have good days and you're going to have bad days. The market's going to go up, it's going to go down. So it's not a good idea to withdraw on the bad days, especially if this is all you have, right? If it hurts you emotionally, then you know you don't have enough in there. It's the same with trading, right? Just to give you an example, if you have $20,000, right, and you yield farm with $20,000 and you're getting, let's say, 150%, APR on ETHUSDC. That's $2,500 per month or $625 per week, assuming there's no impermanent loss, right? You could be in there for a month and ETH does a 2x. So your 625 for 1 week can end up turning into, double that, 1,200 and whatever that is. Same thing with the monthly, but it also could be down. This is going to happen both times, but you need rent every single month. And, there's a chart online that shows the difference in your portfolio if you weren't invested into the S&P 500 for just the best 10 days in the past 50 years. The results are drastic. Just take a look at the screen, like screenshot this and keep it in your mind. It's the same thing with yield farming. There are certain days where the volatility is really, really high to where you can make 10, 20% in a day. Now, if you pulled out a lot of it to pay rent, you don't get to experience the yield that you would have gotten, right? So maybe if you don't have enough, maybe get a job, be able to add to it and get it to a point to where if it's impermanent loss and you still have to pull out, it doesn't bother you as much, right? So like I said, it depends on your expenses, how much time you have to manage your pools, your risk tolerance and all that. However, let's say you have hundreds of thousands of dollars, right? It's a lot easier. Even if you're in an ETHUSDC pool, using the same example, let's say you get 150% APR on $500,000. That's 12.5% per month and 3.1% per week. That equates to $62,500 per month, assuming it's no impermanent loss. But even if it is, even if it's half of that, 30K per month is really good. And that's $15,000 per week. Even if it's half of that, that's over $7,000, right? And that's just ETHUSDC. There are other pools that pay way more. You just have to know how to manage them. I'm just being really, really general with this example. But like I said, you have to factor in the price of the assets you're farming, what network you're farming on. If you're on ETH, the gas fees are going to be a little bit more expensive. So you have more, it's easier to get back in profit in terms of like, okay, I claimed, now I need to make my gas fee back, right? So it could be a good idea to claim daily or weekly instead of monthly, right? I'm just giving you all of your options here. Another option is to use a PAM account structure. And PAMs, I have to look it up real quick because I forgot what it stands for. It stands for Percentage Allocation Money Management. So it doesn't really tell you what it is from the explainer, but basically it allows you to, like when I traded Forex, I had a PAM account. I had one trading account where I was just trading to grow it, and I had another one where I was trading to live off of. And when you do the PAM account, you place one trade, but it does the same thing for both accounts. So you can have two separate wallets where you're in the same liquidity pools or different ones. And you have one where you're, taking your rewards, using them to buy altcoins or compound and whatever you want to do so you can keep growing it, right? And you have another one where you're using it to live off of. So that could be another way as well, because I'm telling you, once the market drops a lot and the floor gets pulled from under you, you're not going to want to pull that out because you're going to want your portfolio to bounce back. So, but if you have a lot of money and you don't have to pull all of it, you just have to pull out your expenses and you still have a good amount left, then it could be a good idea, right? And like I said, part of purchasing our course is that you get an hour strategy session with a coach. It'll either be me or Float Locker or Coach Chris. And we ask you what your goals are, what you're trying to do, your portfolio size. And whatever your goal is, we'll tell you if it's attainable. And if it is, we show you exactly how to attain it. And there are a lot of people in our group who want to live off their liquidity pools, and we help them set up their liquidity pools, help them manage them, help them determine what are the right ones to get into so that they can do just that. So it is possible. You just have to know what you're doing. And that's what our community is centered around. So again, if that sounds interesting to you, book a strategy call in the description. But other than that, I like to conclude this video. If you got value, I ask that you consider subscribing, drop a like, drop a comment, share with a friend. Other than that, I thank you guys so much for tuning in. I love every single one of you watching, and I will see you in the next video. Take care and trade safe.